Equity markets are widely regarded as the strongest driver of long-term investment growth amongst asset classes. While they entail a higher level of risk as corporations may default or collapse, unlike investments in developed bond or cash markets, historical evidence shows that this risk has been rewarded over the long term. The chart illustrates the average performance of some of the most common asset classes between 1930 and 2025. As shown, equities, using the S&P 500 as a benchmark, have delivered the strongest returns, averaging 10.3% over this period. It is also notable that there have only been 2 decades in which the S&P 500 posted negative returns, the 1930s and the 2000s, returns of minus 0.9% and minus 1% respectively. Turning to other asset classes, cash has returned an average of 3.3%, using 3-month US Treasury bills as a benchmark. Cash is the only asset shown to have delivered a positive return in every decade from the 1930s through to the 2020s. However, this consistency comes at the expense of overall return. Notably, cash has exceeded inflation by just 0.1% over this period, meaning that an investor remaining fully invested in cash would have achieved a real return of only 0.1%. Meanwhile, bonds and real estate, both commonly viewed as lower risk alternatives to equities, have returned 4.3% and 4.7% respectively. Bonds are generally considered safer than equities due to their lower counterparty risk and more predictable income streams. However, as illustrated, this reduced risk has translated into materially lower long-term returns, with bonds underperforming equities by approximately 6 percentage points over the period analysed. Finally, gold, which has been one of the strongest performing assets globally in recent years, has delivered an average return of 5.6% between 1930 and 2025. Like equities, gold prices can be volatile, with the asset recording negative returns during the 1980s and 1990s. This was followed by a strong rebound in the 2000s, when gold returned approximately 14% and emerged as the best performing asset of that decade. In conclusion, historical evidence consistently reinforces one key principle. Equities are the primary driver of long-term portfolio growth. For more insights such as these, please visit our website www.seaspareprivate.ie.